Hi, everyone. Thank you so much for joining us today. My name is Delilah Rothenberg, and I'm a co-founder and the executive director of the Predistribution Initiative. We're a nonprofit that is designed to work with institutional investors and their stakeholders to co-create improvements to investment structures and investment governance practices to share more wealth and influence with workers and communities. And we believe that this is essential in the path to addressing system-level risks, including inequality and climate change and biodiversity loss. I'm really pleased to be here with you all. My background's in finance. I've been to several PRIs in person, and it's just really wonderful that system-level investing is making it on the agenda. I'm also delighted to be here with Bill Burckart, who is the CEO of the Investment Integration Project, TIIP, as well as Peter van der Werf, Head of Engagement at Robeco, and Eva Cairns, Head of Responsible Investment in Stewardship at Scottish Widows, and Brynn O'Brien, Executive Director of the Australasian Center for Corporate Responsibility. And I've introduced all of our panelists in a row. I have a few housekeeping remarks for today. So first, this session is recorded, and there will be closed captions. You can look at the app for the agenda, as well as Slido to ask any questions. We're going to have two sets of Q&A. So the first session, please do submit your questions via Slido. We'll probably only have a chance to answer 2 questions. And then we'll have a second set of Q&A where you'll be able to ask a question via Slido or the roaming mic. Please do keep your phone on silent during the session. And we are going to start with a poll. So get your Slidos out. And the poll questions are, do you believe there's a difference between idiosyncratic and system or systemic risks? And do you think that diversification alone can manage these systemic risks? So I think that should be up on the screen. And we'll give you a moment to answer.
Already you're starting great.
This is a very convincing outcome.
Oh boy, all right.
So we have a response, I believe, on the screen about whether you believe there's a difference between idiosyncratic risks and systemic risks. And are we going to present the results for the second question? Do you think diversification alone can manage systemic risks? All right, well, we have a sophisticated audience, it seems like. So I am going to turn to Bill and to Brynn to reflect and share a little bit about how they think about system-level risks or systemic or systematic risks, what the differences are, why it's important to investors. So Bill, why don't we start with you?
Sure. So one thing, as everybody here at this conference, you're hearing the word system or some variation of it. And it reminds me of, who here has a mom or just like a parent that's like motherly? Maybe a lot of the hands? Okay. And I haven't tried to explain what system level investing is to her for years now. And Delilah knows my mom. And she'll just look at me and she'll be like, but are you happy? And I'm like, well, I don't know if you're getting it. So when we talk about system level investing, let me talk about a few key dimensions. So when we think about system level risk, we think about those non-diversifiable risks. When we think about systemic risks, those are those big events, the climate change, income inequality, those things that ultimately create systematic risks, which are those things that are non-diversifiable. English is my second language. So when we think about system level investing, we're thinking about both those kinds of risks. And in contrast to idiosyncratic risks that are specific to a particular kind of company or industry, as opposed to something that's being cutting across all industries, all sectors, or the majority of them. And basically 10 years ago, I co-founded the Investment Integration Project with Steve Leidenberg, and a lot of it was out of the shared frustration of saying, as an impact investor where I came from, there's a limit to what we're really able to achieve. We're not really impact investors, we're outcome investors, maybe output investors. And then he was having a similar frustration as like one of the godfathers of the whole ESG movement, where we've made incremental progress at public companies, but have really fundamentally changed any of these big drivers of these problems or opportunities. And so that's when we got together, and the whole idea with system level investing is that you're acknowledging that essentially the performance of your portfolios and the health of systems are intertwined, they're interconnected. And that with these kind of emergence of these big systemic risks, these systems under stress, that diversification alone, if that's not equipped to handle those big risks, even though modern portfolio theory says, well, you shouldn't even worry about that. And if you heard John LeCommick speak yesterday, he talked a lot about that, the kind of limitations of modern portfolio theory. And so really to go beyond that, if you agree that there is a difference between idiosyncratic and systemic risks, and that you have to approach this differently. So the tool set is not just thinking about asset allocation or thinking about just that kind of constraint to your portfolio level. It's really understanding the context within which your portfolio exists and trying to figure out how to manage that to maximize both long-term performance, but also general stability. One of the things that we often talk about, and this is something that Rick Alexander, Shareholder Commons, is here, Delilah, a few of us have been out there really trying to articulate this idea that the greatest source of returns for an investor is the health of the overall capital markets, the overall economy, not individual stock picking. So system level investors are both seeking alpha, but for them, beta is not silent, it's salient. And so they focus a lot on how do we manage the beta, the health of the overall capital markets for long-term performance. If you heard Barb Zahn yesterday on the panel when she talked about, like, essentially to make good on the pension promise, they need to help manage climate change to their beneficiaries. And so that's the kind of thinking. It does build on ESG integration, it builds on impact investing, it builds on a lot of the portfolio management things that we already do, but it also invites investors to be able to get that influence at that sector or even system level. They're also utilizing all sorts of tools that focus on creating a shared knowledge base, creating more collaboration, and then ultimately informing the rules of the game. While each investor is kind of looking at this and saying, as a institutional investor operating through public markets, or as a boutique impact investment manager operating primarily through private markets, what is my unique leverage points for driving that bigger resiliency within these systems? I'll pause there.
Thanks, Bill.
Yeah.
And Brynn, what are you thinking? What's on your mind in terms of system level risk and how you're approaching it?
So we're on the brink of irreversible climate disaster. This is a global emergency beyond any doubt. Much of the very fabric of life on Earth is imperiled. We are stepping into a critical and unpredictable new phase of the climate crisis. For half a century, global warming has been correctly predicted, even before it was observed, not only by independent academic scientists, but also by fossil fuels companies. Despite these warnings, we're still moving in the wrong direction. Fossil fuel emissions have increased to an all-time high. The 3 hottest days ever occurred in July of 2024. Current policies have us on track for approximately 2.7 degrees of warming by 2100. Tragically, we are failing to avoid serious impacts, and we can now only hope to limit the extent of the damage. We are witnessing the grim reality of the forecasts as climate impacts escalate, bringing forth scenes of unprecedented disasters around the world and human and non-human suffering. These are not my opinions. This is the first paragraph of an article published yesterday, the 8th of October 2024, in the scientific journal Bioscience, authored by a collection of science luminaries: Ripple, Wolf, Gregg, Rockstrom, Mann, Oreskes, Lenton, Ramsdorff, Newsom, Zhu, Svenning, Pereira, Law, and Crowther. We have a custom in this industry, I don't know if you've noticed, that when someone says something scary or sad or confronting or uncomfortable, they immediately follow it with some kind of hope or optimism or a reason to be cheerful. I'm not going to do that for you today. We have another custom in our culture, which in my view is a mistake. And this is a mistake that I've been making for the last 8 years since I've been doing this work on systems level stewardship with investors, and that is to give primacy to the intellect. It's an honest mistake. It's what we all do. We're a bunch of nerds that show up and try to outthink these problems. But we can't outthink this one, so I'm going to do something different today, and I'm going to talk to you about my fears. I'm worried that we're in really, really bad shape. And I'm worried that we're still treating this as though it's a drill, as though we're still warming up. But this is the real thing. The scariest thing I've seen in the last 12 months is work done by our chief scientist, overlaying IEA scenarios with tipping points. If you take the best case IEA scenario, 1.5 with low overshoot, well, we're well within the uncertainty bands for at least the following tipping points: the Greenland ice sheet, the West Antarctic, the coral reefs, the AMOC. Net zero by 2050 is nonsense if we engage these tipping points along the way. This is what systems level risk is. I worry that we as investors are losing relevance, that we're making ourselves irrelevant. We have a vanishingly small window of opportunity. It is growing smaller by the day to do something about this. And these aren't just my fears. Over the last couple of days, I've spoken to many of your peers about their fears, and these are the themes that come up. People are worried that their peers don't understand that past performance is no indicator of future performance, even though it's on everyone's email signature. People are worried that we're wasting our time, that Climate Action 100 has been a waste of time, that this conference is a waste of time, that we are using our precious time together. We are wasting our precious time together. So I could go on. We need to access our emotions in this fight. If you're having trouble accessing your emotions, try explaining dead or dying coral reefs to an 8-year-old who's just learnt to snorkel. Try explaining the collapse of coral reefs, now a scientific certainty, to the 100 million people plus who rely on coral reef ecosystems for their survival. They're just some of my fears. I wonder if they resonate with you.
Brynn, thank you. I think it might be helpful to hear from both Eva and Peter on how do you choose which issues to focus on. These are very serious issues, as Brynn highlighted, and as investors, I think it can be difficult to figure out where to prioritize. So maybe Eva, let's start with you.
Okay. Hard to follow. I feel very emotional just listening to Brynn, so just want to acknowledge that, and I think we will all feel this. So my list of points is kind of, as you were saying, I'm still going to go there. I wanted to show you or tell you a bit more about, and it's very relevant for systemic risks, my own shift from the asset manager to the asset owner world. Mm-hmm. So I'm now head of responsible investment for a large asset owner in the UK, but I only joined in April, and before that I was on the asset management side for 14 years. And it very much is about looking at companies, identifying those that can maybe outperform their peers, looking at leaders and laggards. So absolutely climate change was a priority, but not necessarily from a systems level perspective. And the other thing that's really difficult is that as a global asset manager, you work on behalf of so many clients. There's always this, oh, but this client in particular, with some of the backlash in the US, will not like what we do if we do it as a corporate. So maybe we do that a little bit here for clients in Europe, and tiptoeing around that is really, really difficult. And I wanted to be on the other side and be the asset owner that sets the direction, that sets the clarity and the expectations, jointly with the asset owner community, which is a very strong one in the UK, and I think globally as well. So that approach, when I joined Scottish Widows, it was really clear that actually you need to look at the companies and asset managers operate within a system, or the companies directly. So direct engagement, collaborative engagement is important, but identifying the players in the system that they operate within and getting together for a stronger collaborative voice is really, really important. And as Scottish Widows, we have 100 billion of AUM, which is can be very influential. It's all externally managed through the asset managers. So setting that bar and the expectation for them is really, really key. And I'll say it's been my own personal experience where I was on the asset manager side. Thought, I wish we just had, a really clear direction and a group of asset owners clearly saying this is what we need to make it easier to get things across with the board and so on. So that's a bit of context, but in terms of prioritization, it's really important with limited resources, but also very challenging because we face a range of systemic risks, climate change clearly being an existential risks, but many others when we look at the Sustainable Development Goals and the issues that the world is facing. So which ones do you say no to? From a asset owner perspective, capture kind of 3 key points I think we need to look at. So what you are exposed to generally a wide range of sectors, regions. As universal owners, you quite often, that was the other really learning curve and shift, is that a lot of it is passively managed. You track a big index, you're exposed to many sectors and regions. So what can we do? What is the exposure and some of the systemic risks that really impact your whole portfolio and really result in whole collapses of economies, financial markets? It isn't just about companies in your portfolio. The other one, the additionality, and where can you really add value? Where do you focus your activities? What opportunities are there to influence and impact and contribute to collaborative initiatives, shape best practice, engage with policymakers? So how can you influence the players that create that system? We also, and I think that's quite important, ultimately as a pension fund, you have your end customers, and we try to seek their views on what is important and reflect that in our thinking as well. And we've seen increasingly, you can see people care hugely about how you look at climate change and social issues in your portfolios. So I do think bringing the wider public along and their support is really, really important. So where are we with priorities on systemic risks at Scottish Widows? So climate change, absolutely one that has been there for years, but the focus is really one on real world transition, not just portfolio decarbonisation. Many of you will, I think, associate with that, and also just transition. So that focus on people and ultimately understand the impact on people and the disproportionate impact on people, communities, workers is really key in the climate change focus for us. Nature is increasingly emerging as well. We want to focus on deforestation, water and pollution. And really importantly at Scottish Widows, and that was something over the last year or two, human rights and inequality. And I think these are things that can impact whole economies, destabilize the political system, and that makes it more difficult to set the right policies to tackle a wider range of systemic issues. So I'll pause there.
Thanks so much, Eva. And on the point of inequality, I should also mention, some of you might be aware that there's been a task force on inequality and social-related financial disclosures that launched to support investors and companies in understanding their impacts, dependencies, risks, and opportunities related to inequality and also the just transition. Peter, let's hear from an asset manager perspective. We heard the asset owner allocator perspective. How are you choosing what to focus on?
Yeah, thanks, Delilah. And I think when I reflect on Robeco's priorities when it comes to dealing with this question of how do we work on the one hand as an asset manager in listed equity and fixed income, and to a lesser extent in sovereign bonds. We obviously have a very strong focus and had for the last 20 years on how do we address individual performance of the companies we invest in. And as a fundamental investor, obviously that stock picking is really an important key trait of what we do. But then if we look at our evolution, where we've invested a lot of time and effort in developing a sophisticated net zero roadmap, we're adding nature targets this year to that as well, to address some of the really large systemic challenges that I think intellectually, as Brynn mentioned, we all recognize in the room here. But we've then also said, on top of the work that we do with these corporations, and in spite of the limited progress that we're seeing, there is this additional element, sort of, in my mind, this is conceptually a triangle between investors, corporations, and governments at the top in terms of how they all influence each other. And I think this is where a lot of our systemic risk work from an engagement perspective is now also turning into how do we address our expectations to governments. So we've been involved in the investor policy dialogue on deforestation with Brazil and Indonesia since 2020. We've been spearheading a group that the PRI has put together to engage with the Australian government. And while, and Brynn will be the first one to challenge me on that, there is still a lot of progress that needs to happen. I do see a huge increase in the work that we can do. And if I make this also a little bit more personal, based on sort of the perspective of fear, because I was going to exactly the same report this morning before this panel, and I recognize that I've studied Earth System Science back in the Netherlands. I've gone through all of the work. I saw all of the predictions, and it's all coming to fruition now. But at the same time, there is a moment of action and an opportunity for leadership for all of us every single day to make that change. So yesterday I was emailing the Dutch government if I could get a blue zone accreditation for COP29. I know that most of us here in the room actually told me we're not going. This is a bit of an intermediate one. For me, that's a double reason to say Robeco should be represented in Baku to actually address sovereigns that we invest in, because we finance their budgets, and we need to sort of close this triangle between investors, corporations that are there and that are speaking up for their short-term vested interests. And we need to bring that long-term perspective to really show that ultimately, if we don't address this systemic risk, there will be significant impacts on our portfolios. So to me, this all comes back to the ultimate fiduciary duty we have to all of our clients to manage these long-term risks. That's the starting point. But at the same time, I feel every day still very much empowered to then also take that opportunity and look for ways where we can express and give voice to the capital that we represent, which we did in Canberra last month when we spoke to the Treasurer and the Minister of Climate Change, asking for an ambitious NDC target. Tomorrow morning, we'll be having meetings with the Ontario government and federal government here in Canada. So I think there is really avenues for all of you in the room here to express these deep concerns and to turn this fear into a mode of action. So from my perspective, that's a way how, from Robeco's side, we very much see an opportunity to represent our clients and then also really start addressing systemic risk where it obviously is very much apparent.
Thanks, Peter. I want to turn to looking at some case studies of what does this look like in action. And we did have a question that came in already from Adam Matthews, and I think, Brynn, this is somewhat directed toward you. And so as you think about a case study or what you'd like to share with the audience about working in action, the question is, responding to Brynn's challenge, do asset owners need to recognize that Climate Action 100 needs to change? What's the point of using our finite stewardship capacities on oil and gas? Shouldn't we simply support fossil fuel moratorium by governments and use our stewardship to shift demand side companies with urgency? So, Brynn, maybe you want to comment on that, and then it would be helpful to hear from the other panelists on case studies I think Eva and Peter, you might have some that you have engaged with directly. And Bill, I know you did some work on case studies that's been published of looking at different investors too. So that might be worth mentioning for the audience and telling the audience where to find that. So Brynn, let's start with you.
Thanks for the question, Adam. I appreciate it. We need to be doing both. So here's my pitch for why investors should remain engaged with oil and gas companies. In the last couple of days, the government of India has announced that they are going to make it easier for oil and gas companies to increase production in India. And in announcing this in the last couple of days, the Indian oil and gas minister said, yeah, I'm doing this because I've just come out of weeks of meetings with Exxon and BP and a bunch of other companies. So Exxon and BP and other companies, Shell, we know is absolutely doing this. Companies in many of your portfolios are still actively lobbying governments to increase supply and to lock in demand. And we need to be making sure they don't do that. Like this is why we need to remain invested in these companies, and this is why we need to keep engaging with them. So over the last 12 months, ACCR did an extensive piece of research on Shell's lobbying to lock in demand in emerging markets. Shell were disclosing some of their lobbying, or they were disclosing the lobbying that they were doing in the industry associations that they were doing in developed economies, in Europe, in the United States, in Australia, and so on. They were omitting disclosures around the lobbying that they were doing in emerging markets in India and Indonesia and other countries. So after having exposed that and partnered with Sam Pension and KLP, we went to Shell, we filed a shareholder resolution calling on them to tell us what you're doing in those markets. They were embarrassed that we had called them out, and they committed to making some disclosures, the first round of which will come out in November. I'm not expecting that they will be great disclosures, and I'm not expecting that they will solve the problem, but from a systems level stewardship perspective, we need to be keeping the pressure on the companies in our portfolios to not use their political influence to do things that are incompatible with a safer future for us all.
Thanks, Brynn. I think, Eva, it would also be helpful. I don't know if you plan on touching on a case study around the just transition, but particularly when we think about emerging markets and climate, that's helpful for the audience to hear.
I was also going to comment on the question from Adam, which obviously also asks about asset owners and thinking about how, the different stewardship levers and how effective they really are. And I am very concerned around, and as I say again, 4 or 5 months on the asset owner side, but the amount of effort that's gone into certain initiatives. And then you see the large oil and gas majors, Shell, BP, backtracking on their commitments. And what are the consequences? Who's actually going to say that's not okay? I do think the political environment is absolutely crucial to help tackle that, because it comes from individual investors, or even, again, looking at how they escalate and whether there really is a consequence. I'm not entirely sure this is working effectively. So that's a big area of concern. What are the levers and company or even collaborative company engagement versus really tackling the environment and the system they work in, the incentives they have to grow the business the way they're doing. So that's a big concern.
Thanks, Eva. Peter?
Yeah, so I would agree with that there is a lot of elements in sort of how we've weaved together the system that we are as a financial community are part of, the space that there is for corporations, and ultimately also the opportunity to influence governments to their short-term benefits. And we have a lot of debate internally how to deal with these companies that are backtracking on their targets, and what should be our position. And again, to me, this comes back to the question, what is the assignment that a lot of our clients are mandating us with? Is this to deliver a semi-passive quantitative solution that's very close to the benchmark. Well, in that case, there is a lot of these energy stocks that will still sit in that portfolio, particularly in periods of the cycle when the energy sector is really outperforming. And obviously, we then put on a lot of our efforts in the engagement, and ultimately, we try to bring the best choices in that portfolio to our clients. But it really stems with sort of the fundamental choices that asset owners are taking in terms of the assignment that they're handing out to asset managers. And I think it is ultimately a lot of the collective action in Climate Action 100 with the likes of ACCR, or I saw Josh Sinner come in from ICCR here in North America. All of these collaborative platforms, they really give us an avenue to continue to push for change. And I'm positive that if we continue to up the ante, that we'll be able to better articulate how these companies are contributing to these systemic risks. And at the same time, it is ultimately up to governments and other regulators to also create a level playing field where the solutions ultimately are getting a better opportunity, also from an economic perspective, to outweigh some of the fossil fuel economics that we still see. And I think this is ultimately the biggest systemic shift that we need to go through, which is it asks long-term leadership to really back the transition. And that, for my part, one of the biggest concerns I have is that I really lack a lot of this political leadership across the world. And this is actually what I felt most when being in Canberra, is that giving the leaders in power in governments the backing that the financial industry has their long-term strategies and is covering their back is really very powerful. And again, I think this is really my call to action. Often we're very disjointed. We don't really bring this voice together. We don't have sort of a collective way into the capitals to actually bring this message. When we get better organized, I think this will also really help those in power to then show, but this is actually what investors want us to do, because they are investing in bonds that have maturities beyond 2050. So they want us to actually do the things in which they think we can also deliver on the economic growth beyond that point. And for that, we just really need to bring this into perspective.
And Bill?
Sure. So I'm going to tee into a couple of the things that they've said. So TIIP, over the years, we've consulted with different investors. We've also done a lot of research, kind of building an evidence base for who's doing what. How is this different from portfolio level focus, sustainable or impact investing, and then what does it look like at that system level? The report that Delilah mentioned, it's called System Level Investors, First Movers, I'll find it. It's freely available on our website. But we profiled a couple of investors, and so that's I'm just going to tee into a couple of things. There's essentially, when investors go down this road, they're thinking about it either in terms of integrating this kind of system level focus across all the steps in their process. So everything from deciding where to focus, to goal setting, to allocating assets, applying advanced techniques or adapting conventional investment techniques, and then ultimately trying to figure out how to evaluate progress. Now, in the profiles that we did, which if you see Mary Beth Gallagher of Domini, I don't know if she's here, we talk about how Domini has gone about essentially setting goals as it relates to biodiversity loss, but also essentially increasing resilience. One of the things that they focused on was forest and land use. And one of the interesting things about setting goals at a system level is you kind of have to acknowledge the interconnections and the trade-offs. So if you're thinking about they were able to confirm that, hey, we're exposed to deforestation that's going to destabilize our portfolios in these different ways. And so then they were able to set goals where it's to say, look, we've got to balance, are we preserving more land because we need to combat climate change, or are we cultivating more land so we can feed more people? And that anytime you set these kind of system level practices and approaches, you ultimately have these kinds of trade-offs just because of the inherent complexity of what you're doing. It invites the fact that you not only focused on value creation, but also value preservation and some level of extraction. You have groups like University Pension Plan where, like I said, Barb and Delaney Craig is here somewhere maybe. So talking about our investments, that our ability to make good on the pension promise is due to the health of climate, and that our actions as an investor ultimately influence the health of that climate. So really making that connection that this is relevant and that they can ultimately also effectively do something. There are plenty of others. Cambridge Associates has done a lot of work around thinking about the utility of asset classes. So you're not just allocating assets anymore. You're thinking about what is the actual functional utility of that asset class in a system. So really putting the system needs of the system first. Different asset classes have different virtues. So, fixed income, particularly when issued by municipalities, helps create public goods. When you think about disruptive, innovative change, think VC, private equity, so on and so forth. They're looking at investment belief statements, they're looking at investment manager agreements, they're thinking about their portfolio construction and engagement, and they're thinking about ways to enhance all of those. And so if you've seen, I'm going to just mention Rick again, shareholder comments, thinking about some of those different levels of engagement that now need to occur. You're not engaging like a specific company. In some cases you are if it's a bellwether, but you're also thinking about how do we engage an entire sector? And then ultimately, how does that help to contribute to system level progress? And they're making the case, and all of the investors that we've profiled, they're all making the case that this is not incompatible with fiduciary duty. It actually helps satisfy fiduciary duty. And part of that, if you heard Tiffany Reeves yesterday, one of the things that she'll point to is just this idea that when we think of systemic risks, we're thinking about intergenerational risk, and you can't preference the needs of today's beneficiaries at the cost of tomorrow's. And so that leads it straight into the consideration of this at a really practical level. And then you've seen that, and I'll shut up now in a second. So I've mentioned a couple of names. I mentioned Delaney, Mary Beth Gallagher, Barb, Westpath is Jake Barnett's here. The reason, there he is. He's very tall, so it's hard to miss. But all of them are, one of the other things is that there's always a champion. There's always a champion at these institutions that is kind of essentially quarterbacking this, trying to get it pushed through. There's a lot of organizational change management that goes into this. And so the role of those key players, Kirsty Jenkinson, she was on the thing yesterday, she's been the key driver there. So thinking about some of those core components is, I think, helpful and looking at those case studies in
Thanks,
detail.
Bill.
I'll shut up now.
No.
Can I-
Yeah, and Brynn, did you also want to jump in?
sorry.
Go first.
I was just going to say on the case study, because you mentioned just transition, I was still going to spend a couple of minutes on that, if that's okay, because So because I talked earlier about climate change in nature and social, and I think the inequality and the impact of that that it has linking to environmental policies and just transition issues is really important. So we've just recently published our approach to social factors and how we see them as systemic and how they are the foundation of economies being able to drive the environmental issues as well. And that is an issue not just globally, where we see, I've got the stats here, the latest stats, 50% of the global population hold 2% of wealth and 1% hold 40% of wealth. If that really causes that instability, economic and political, if that gets worse. And something like the just transition, so the disproportionate impact on people, communities, and how we think about that to move the energy transition along is really critical. I was going to give a shout out to Adam and the Global Investor Commission on mining, and the report that's just been released this week on the mining sector being so fundamental. I mean, it combines so many of the different systemic issues we're facing and how we need the sector to enable the transition, but also tackle a lot of the human rights issues that it's facing. So that's a really good example of a very specific sector that needs to be, part of the journey. So I think I just wanted to highlight that those social and human rights and inequality factors really go hand in hand, and if they can exacerbate what politicians can do to set the right incentives for the energy transition as well.
Really glad you're emphasizing that, Eva. And Brynn.
Just want to return again to Adam's question. It's very provocative and a very good question, but I think that perhaps this community is unique because it is afraid to use power. So what I mean by that, I think there's this assumption, or there seems to be a misapprehension in relation to the oil and gas companies, for example, that it's not worth it, we don't have any power, we can't get this done. It's wrong. Like formally, legally, shareholders in companies have rights that they can use, that they get an opportunity every year at the AGM of the company to use. The Shareholder Commons has done excellent work through their portfolios on the ballots initiative, showing us how to use those rights to steward companies for the system, right? So if the directors so you've got an oil and gas company that is lobbying against your rational economic interest, your fiduciary responsibility to your beneficiaries to manage for intergenerational risk, to manage for future risk. And that company has a board of directors who are up for election every year. Don't be afraid to use that power.
We hear some enthusiasm from the audience on that
That's
comment.
Rick Alexander, because I've plugged his
Rick,
initiative
raise your
vote.
hand so people can also come up to you afterwards. Rick Alexander from the Shareholder Commons is right there. For those who want to learn more about the amazing work that the Shareholder Commons is doing as well. So we're getting a number of questions from the audience about incentives, and that was a topic that I wanted to make sure that we touch on in terms of how are the incentives of stewardship teams and the investment teams aligned. And we heard yesterday about issues regarding benchmarking and how that can prevent sustainable investing. We have a question here about that from Zarina Nazib. Asset owners often speak about using capital allocation to drive net zero through stewardship. At the same time, we keep hearing that they want their portfolio to be close to the benchmark and have low tracking error. So how do you deal with this direct discrepancy of incentives? And I also want to just touch on the question that right now has the most votes from Rosa van den Beemt. Is safeguarding the health of natural and social systems possible within an economic growth hegemony, given our economic system relies on extraction of nature and labor to create wealth? Sharing my own fears as someone with a lifelong career in responsible investment. And this is something that I've been thinking about a lot as well. I mean, our benchmarks are really reflecting historical or status quo market performance that undervalues human, social, and natural capital. And so that may really be preventing our investment teams from working in ways that are aligned with our stewardship teams. And so I wanted to just open it up to the panel to reflect on that issue and how might we address it?
I'm happy to comment from my own experience moving from a very active asset management approach where I was before to joining a pension fund where you are right, there's a lot of quite often cost pressure on pension funds, and it ends up tracking more passively an index and following a benchmark, and also being quite risk averse and not wanting to be too different from the benchmark, but at the same time recognizing how important it is to embed responsible investing. So 2 things. I would say that in terms of the actual investments, you can still do certain things that move you away from the benchmark a little bit in the passive investment front, whether that is through tilts, exclusions policies, and so on, and have a combination of funds that have different objectives. But irrespective of whether you're actively or passively invested or what your tracking error is, the stewardship that you do on the systemic issues that impact your portfolios, that still sits above that and around that. And that, on the asset owner side and through the asset managers that are delivering that for you, that remains a key priority, irrespective of whether that's passively or actively invested, in my view.
Other views from the panelists?
Yeah, so from my perspective, I think there is obviously a very clear link between further economic growth, population growth, and ultimately the amassing wealth in the emerging middle class in emerging markets, and therefore also our global footprint. At the same time, I think there is opportunities in sort of the creative destruction that capitalism often brings in terms of shifting in that transition to new sectors and new opportunities. It's just that from an economic perspective, we haven't seen them work, and from an economic environment recently. What gives me hope in that is that if you look back in history, there have been significant moments when we made moral and ethical choices, and I have to think about a book I read recently from Rutger Bregman, which is on moral ambition, where he gives a call for people to really step up and take that leadership, where he describes the moving away from slave trade, which was a very economically beneficial activity, and a lot of plantation holders, the Dutch, the English, many others benefited from that. And yet they made choices in the middle of the 19th century to move away from that, which took a lot of political and ethical leadership to put a ban on slave trade. And I think it's those type of examples that give me an inspiration, that I think we have an ability to really bring these changes into perspective, even though our economic system currently is driving indeed a much larger footprint. Because from a sort of cultural perspective, the message of degrowth, I think, is a very hard one from a political perspective to get support for any of the choices you would want to make. So while intellectually I think there is a basis for that, I don't think we'll be able to move there. So it will be really up to politicians to show us the way here.
So I would say a couple of things. I think one, when we talk about that divide internally at institutions, I mean, this is something that we've come across with a number of them, where it's kind of almost, think about the structure of how your decisions are being made. I'm going to go back to the champions, right? So in the case of, I hope I'm not blowing up anybody's spots, but like in the case of Jake at Westpath, he's a direct line into the CIO. And so everything he's doing is being contextualized and with the blessing of that kind of authoritative perspective. So that divide between the investment managers as well as stewardship is not, it's kind of blended, right? Kirsty has the same benefit given where she sits at CalSTRS. So thinking about these things where you're better integrating, there we are.
Yeah.
Yet again, English second language. Integrating it is my first language. But integrating these teams so it's not some sideshow on the side, but actually really in the meaningful decision-making process. That's thing one. I think thing two, when the question about can we do all this, what about extraction? The reality is there's still going to be a certain level of extraction. Like that just is the nature of how we work. But I think the level of it and how we go about it and how we do more value creation, value preservation, these are all these like things that we still have to figure out what the right balance is. And it's kind of symptomatic of where we are as an industry or where we are as a broadly defined field, in the sense that I have the benefit of having a 79-year-old business partner who, like when KLD Analytics, when they were doing initial profiling work on companies, like they were using hard papers and like cutting out clippings, and they would have to wait for annual reports to come in the mail. I learned what snail mail was. I didn't know what that was. It's mail coming through the mail, not electronically. And it was one of those things where that's where they were just 25 years ago. And you think about now where you can see what's on Bloomberg Terminal, you can see all of this incredible thinking that's come out of Predistribution Initiative and other groups that are doing really great work trying to interrogate these systems and really trying, a lot of what TIIP, it's that, you're putting that needs of the system first. So like one of the things we always talk about conceptually is like, what would an index look like if it was based on the needs of a system, not best-in-class companies within an industry? And so it's thinking about that where it's a lot of that kind of rethink. So I think it's restructuring teams. I think it's partially just the patience that comes with us really building this field out and institutionalizing, professionalizing it. And then I forget what my third thing was, but I just said it, but I forgot it. So Delilah.
Thanks, Belle. And
Yeah.
Brynn, you wanted to comment on this?
Just want to jump in on the incentives point. Thank you to whoever made that comment. You've diagnosed the problem. So we have our objectives and our incentives totally around the wrong way. There's no law that requires you to beat the benchmark. There's a law that requires you to act in the best interest of your beneficiaries, which includes actively managing for risk. The only thing that we can do to prevent this catastrophic risk from destroying lives and portfolios, the only thing we can do is reduce emissions now. The only time that matters is now. So we need to set up, asset owners need to be demanding from asset managers products and incentivizing those managers to reduce absolute real-world emissions. Returns will be made in that context, but there is no piece within the architecture of our industry that does that, that is incentivized to reduce emissions in the only time that matters, which is now.
Yeah, thanks, Brynn. I'll just also comment on this from my own experiences and perspectives. I spent the first 4 years of my career in public equities on the sell side, and then went into private equity, infrastructure, and project finance for the next 10 years or so. And one of the things that I saw from being on the asset management side was that we would have our LPs encourage us to treat workers well and communities well and steward the environment well, but that would be the ESG or stewardship teams, and then you'd have the investment teams who are saying, we're going to allocate capital to you if you're in the top quartile, right? And we need to meet or exceed this financial benchmark. And so questions arise if you're investing in real estate and rentals, are you not going to hike up the rents, and are you going to be responsible when it comes to maintenance costs? And what does that do to the return? And I think there are some real tensions in some of these issues that are important to address and acknowledge. We do have a couple of additional questions. We only have 3 minutes left or so maybe I'll just share them for reflection. And then we can do a quick fire round across the panel to see if anybody wants to say anything very quickly in their closing remarks. So the questions with the top votes right now are from Tom Arup and from Simon Rawson. Tom's asking, for the investors on the stage, what resourcing and types of skills are required for system-level stewardship, and how do you think the industry currently has the capacity to follow through on this practice in a sustained manner? And Simon's question is related but different. So thinking about who's here pitching services at this conference, do the panel members have thoughts on the role of service providers, such as proxy advisors or ESG ratings, as a barrier to system stewardship, as long as they continue to take an enterprise lens on all that they do? So as long as they continue to focus on that idiosyncratic risk and return versus system level. So let's just change to 21 minutes. Where are we on the time?
Well, that's a good sign. We're getting some more time.
Have we got till 11?
Yeah,
we got 20 minutes.
Okay. So I guess the timer's a little off. Okay, so we have lots of time. Why don't we? This is what I'm not good as a moderator. This has happened before. Okay, why don't we reflect now on the skills that are needed and the role of service providers? Who wants to start?
Yeah, I'm happy to take the first question. So I think what would be really helpful is if asset owners articulate this understanding of systemic risk in the assignments that they hand out to asset managers. So ask about policy engagement. Ask about how do you address systemic risk when you manage this portfolio for us? What are the actions that you're taking? What is it that you can do to represent us? Because I think this ultimately empowers a lot of us in the room here that are working from an asset management perspective to actually bring this into practice, rather than just focusing on you invested in these 100 stocks, what are you doing with those? Because there's a lot of the other universe that you're not addressing at that time, and there's a lot of the risks around climate change, nature, and some of the inequality risk that sits there, which your asset manager is not delivering for you. So I think that would be a key element from my perspective.
Can I respond to that briefly?
Absolutely.
Because it's a great transition to something I was going to bring in, but something that asset owners have been working on over the last year or so, after looking at, particularly around climate stewardship, some misalignment with asset managers on voting. And just this week pulled together a statement on climate stewardship from asset owners that others can sign up to, so that there is consistency of an expectation that asset owners, as I say, can sign up to, that can then be shared with asset managers. So something to come. And a shout out to Leanne in the front row, who's been leading on that together with Shipra and my team and Brynn. But this was to tackle exactly that, to set out key principles around expectations to tackle systemic risk, and that look at public policy engagement, collaborative initiative, prioritization frameworks, systematic voting, and the resourcing needed to deliver stewardship. So these are the 5 principles, and that is something that is, as I say now, for asset owners in the room, available to look at, sign up to on the PRI collaboration platform, and then ultimately can be a good, consistent expectation setting around climate stewardship with asset managers.
Yeah,
Can I
Brynn.
just jump in on the skills and resources required to use rights, to use power? I think so. I think that's vastly underestimated. ACCR is a team of almost 40 people, 30 of which are in service of the use of rights across about 12 to 14 stocks at any one time. So I think we're probably, in terms of having an extremely concentrated portfolio and very well-resourced strategy, that's what's required. Like that number of people. And in terms of the skill sets, what you require to use rights, you need strategy, which I think is vastly under-resourced in this sector. You need legal, you need communications, you need investor engagement, and you need analytical skills. At a minimum, they're the skills that you require. I don't know if there's too many other stewardship teams on the planet that can bring that skill set together and the resources required to support it. So I think that's a really good call out on what's actually required. And by using rights, I mean running formal campaigns to change company strategy, not the kind of higher level piece, but using the rights that you have as shareholders. You need those skills and that resourcing.
Great.
I would say, one of the things that we'll often say is like you're adding an ownership discipline to the buy-sell discipline. That is like one of the better ways to think, I think, about this new role of asset owners. But beyond that, so when we think about the service providers, I'm a service provider, Shareholder Commons is, Predistribution Initiative is, we'll be doing a side session tomorrow about that. But beyond that, one of the things that we've really focused on, so in 2021 and 2022, we did an industry needs assessment, really trying to surface through surveys, focus groups, and target interviews, what were some of those big barriers to teams being able to advance forward on this. The thing that came up loud and clear was definitely capacity building. So trying to understand exactly to the point, how do we create the right incentives? How do we resource this? And then how do we execute on something that it's not just a fund. It's not just a individual policy. This is meant to be holistic. It should be touching across all your policies, programs, and practices. There are a number of things right now. So there's the work that TIIP's been doing around kind of investor cohort programs, one-day intensives that we've been doing in partnership with the PRI. I think Kimura-san is here right in front of me. We've done stuff in Japan and Australia and Canada, here in the U.S. And part of that is really helping people think through all of these different dimensions, but also having the right team members with them at different points. Because if you look at, I'll just go back to the university pension plan example, you had buy-in from the entire board, you had the C-suite, both Aaron and Barb, Brian Mins, Delaney. I mean, you just had so many of them that were engaging in different ways with us. And that's it. It's same with Domini. I mean, you had the buy-in from the top, and then it cascades through the entire team. And they even had the whole thing where they initially started focusing on 8 systemic issues. After 2 years, they realized that's overwhelming. They focused in on 1, and now they have a really coherent and really effective forest program. So it's thinking about this where, yet again, don't treat it like a sideshow, that there are resources for people to get trained up to be able to start to bridge those divides, even internally.
Great. Yeah, Eva,
I was
did you
going
want
to
to
just very quickly on incentives, because we've all talked about them. And something I passionately feel about from a perspective of studying economics, environmental economics 20 years ago, at the time writing about carbon pricing, and that you very much need those financial incentives that it's a no-brainer. You price the externality, the businesses know that it's financially the right thing to do something. You don't need to rely on the morals necessarily, but you set a very clear price on carbon, and that incentivizes you to invest in the right projects. And I regularly check the World Bank carbon pricing dashboard, if anyone knows this. And at the moment, 24% of global emissions have a carbon price attached to them. And this was 20 years ago when I did my dissertation. A Stern review came out, said we need carbon pricing to incentivize investment in the right way. So 24% of global emissions, and only 1% at the right level that's needed to meet the goals of the Paris Agreement, 1%. And that is the Scandinavian countries and Uruguay. So I periodically check to see what the progress is, and it is very limited, but I do fundamentally believe those policy incentives that drive what's happening in terms of where investment goes are really critical to address. So directly as asset owners engaging with policymakers, but also expecting our asset managers and companies in terms of their engagement, responsible political engagement activities.
Yeah, one thing that comes to mind is that, particularly at a time where ESG investing and even systemic stewardship is being questioned, is this a values initiative, values driven, or is it about value, right? And there's the political backlash. I think one of the key questions that comes to mind is how do we really know when these system level risks are going to hit our portfolios and by how much? And it doesn't feel like that issue has really been sorted. I think, for climate change, it's a very clear existential risk. When we're thinking about biodiversity loss and certainly with inequality, I think it's really harder to articulate. And I wanted to give a shout out to an emerging initiative, the Externality Investment Research Network, that is going to bring together academics and industry practitioners to work on this issue, because it can really, help investors pursue stewardship goals more comprehensively. So we have another question from the audience about whether traditional engagement is enough and whether we should be pursuing perhaps legal action. And this question is from Pierre DeVici. So what do you all think about pursuing legal action?
I can comment as a litigant in active proceedings at the moment. So ACCR sued Santos, Australia's second largest oil and gas company, 3 years ago now, for misleading and deceptive conduct. We allege that Santos's climate action plan, which they described as clear and credible, was neither of those things, contained a number of misleading statements. And we are shareholders in Santos. We have used the rights available to us as shareholders, the kind of conventional set of rights available to us. And we are not satisfied with the result. And so we're in litigation. We will go to trial in a couple of weeks' time, actually. We're in court for 3 weeks from the 28th of October. So yes, absolutely. We think that litigation has the potential to activate broader systemic change, but that also a systematic legal approach to companies in your portfolio should be taken. So when I say legal approach, I don't just confine that to litigation. I think that engaging law firms to engage your portfolio companies in correspondence about risk management, engage their directors in legal formal correspondence about risk management is a really important strategy that is underutilized by the sector, and there is potential there.
Any other thoughts from the panelists?
I would agree. I think in terms of having escalation strategies that demonstrate this engagement is not working and voting hasn't been sufficient, that you take those steps. Don't have any exact. I don't think we have gone down that route. It's probably would be important to explore what, from your perspective as well, the resourcing needed, the skills, the time it takes, and what are the criteria for actually saying it's the right time we need to pull that trigger and be mindful of all the implications that come with it.
Yeah, Bill.
So I would answer this in a slightly different way. So one of the things that we talk about, like one of these system level techniques, is around self-organization. And it speaks to this kind of broader bucket of activities that investors could do to better collaborate, right? Because we're a competitive industry. And one of the groups, so in the US with the ESG backlash, everybody's heard of Fearless Fund and the situation there. Well, a lot of people have been receiving letters. A lot of people are getting sued. And so it's a different angle on it. But one of the groups, Adesina Social Capital, so they're one of the kind of leaders around racial justice investing in the US. And everybody kept voicing, God, this is like we're all at the mercy of being targeted for just doing this work. And they started something called the freedom economy. And so what they're doing is they're essentially pulling together a bunch of different players, law firms, and essentially helping to create infrastructure that if you're an emerging manager, you're someone other institution in the space that's being targeted, that you can tap into this, that they will collectively help to defend your right to do the work that you're going to do. And it's a different way to think about it, but it's that missing infrastructure. Barb Zahn mentioned yesterday on the panel that they were joining Climate Action 100+. Not enough Canadian companies met the threshold to be targeted, so they helped create this version of it, Climate Action 100+ here in Canada. Yet again, self-organization. It's another platform in which to get investors to collaborate, to co-invest, to act together. And I think, so when I think of legal challenges, I think that there are really important cases where it's like, these are going to help create a breakthrough that otherwise wouldn't have been there. But I do think that also thinking about it from the context, at least even in the US with the freedom economy work, where it's trying to create some of those, I don't want to say guardrails, because, but it's helping to create some of those stabilizing infrastructure, is what we say.
Yeah, from our perspective, we strongly prefer constructive engagement with companies. I think observing the litigation environment that emerged in the US last year, particularly around shareholder resolutions on climate, I don't think is helping us as asset manager and the industry at large, and ultimately also our ability to then execute our shareholder rights. So I'd be very cautious in using that instrument, and I think there is ultimately also a choice that you as an asset manager and as an asset owner have, which is to no longer invest in the company if you don't believe in their approach.
Thanks. We have a question from the audience. How do you make leadership agree on emerging systemic risks like climate, human rights, nature, in addition to traditional systemic risks like inflation and interest rates? Maybe that goes back to this, the work that the Externality Investment Research Network, by the way, that's being advanced by Jim Hawley and Costanza Consolandi and John McComnick. I think that speaks to some of the work that they might be doing. But I think particularly Eva and Peter, within your institutions, have you been able to make that case? And what are you hearing from your peers as well?
Yeah, I would say absolutely, but it's making a clear case and demonstrating the risks and why it matters to portfolios financially. So the way I position from a pension fund perspective is that obviously our customers are long-term investors. They will retire in a world. What's that world they'll be retiring in? So looking at things like climate change matters for the financial resilience of the portfolios, understanding the risks, bringing examples and case studies around that, but also the upside potential of the opportunities that come with the energy transition. So it becomes, from a financial perspective, a very clear case that we need to think about how that is within the portfolio. But then the bigger picture of the systemic risks and the stewardship case, and that therefore tackling the issues at systems level helps create a better world for customers to retire into, and helps, again, the financial resilience of the portfolio. You do need to explain why that is. As a pension fund, the question is, why is it in the best interest of our customers? And to bring that and to understand why. But that is very much, we have policies and frameworks where that's embedded, a stewardship policy, a voting guideline. So it's very much recognized and accepted. There's no pushback, and to say, well, in comparison to the other risks that were listed.
Yeah, and at Robeco, we've incorporated these systemic risks in our risk management teams. I was in a meeting recently where we got an update to the senior leadership. And all of these climate risks are tested on portfolio levels. They're tested against our net zero roadmap. They're tested against all of the different levels of how they could be a risk to Robeco and ultimately to how we service our clients. So from that perspective, I think it's part and parcel of how we should be thinking about making long-term investment decisions, and therefore risk management tests again any of those risks.
Just one quick one. Nature, I think, is more difficult, because I think with climate, it's a little bit clearer and easier and more measurable and so on. I think, still on a journey to make sure that people understand when we say nature-related impacts and dependencies, and we talk about, invasive species and so on, connecting that sometimes can be more difficult for senior leaders in my experience.
So we have a criteria that we developed with a bunch of investors to think through how do you make sure that you're not settling on kind of individual values type issues or idiosyncratic risks in terms of the strategy. So how do you make sure that what you're ultimately focusing on is a systemic risk and that it is relevant to your practice? So the criteria is consensus. So is there global authoritative consensus that this is a systemic risk, and in what ways? And you can do that through a couple of different means. Then it's establishing relevance. Is this actually relevant to risk mitigation, to opportunity generation, and in what ways? So really establishing, just because you might be interested in something, you as an investor, it may not be relevant to you. So having to take that into consideration. The third part is effectiveness. So can you as an investor, given the type you are or the way that you operate, can you actually effectively do something? What are those key leverage points that you can start to push on? And then ultimately uncertainty. So can you model out, we talked about the difference in 1.5 degree rise versus 2 degree, all of that. Really starting to model out what the potential is that of what your investments look like and impacts on your beneficiaries long term. So consensus, relevance, effectiveness, uncertainty, and we found that model. A really good illustration, if you look at some of the work that Fidelity International has been doing under Emily Goodall, a lot of their nature plans, their climate plans, that she's done a lot of this, and she's also showed how, I mean, we're all big fans of Emily Goodall here,
we
so
are.
yeah. But check that out, yeah.
Yeah, that's great, Bill. Thank you. So we only have a minute left, and I did want to just emphasize that PRI has a number of resources on this topic on their website. They just put out a blog on system-level investing and what is it, and it has a number of different resources, some of which we mentioned already on the panel. I also want to highlight that PRI, together with Generation Foundation, put out a great briefing. Well, I guess briefing would be brief. It's a rather long document, but there's an executive summary that summarizes the legal framework for impact and talking about how addressing systemic issues can be within your fiduciary duty as an investor. So highly recommend checking that out. I want to thank all of the panelists, and why don't we give everybody a round of applause? Thank you all as well, and we look forward to continuing the conversation.